This interview is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to Cambridge House Live. I'm Vanessa Collette here at the Canadian Investor Conference, Vancouver. I'm joined by Alex Daley. He is the Chief Technology Investment Strategist for KC Research. Welcome, Alex. Great to have you here.
Thanks for having me, Vanessa.
Now, Alex, what of all the various tech trends out there are you the most excited about right now?
Well, what I'm most excited about is actually one of the characteristics of technology itself. You know, tech has a tendency to go through this kind of love-hate relationship with various different bubbles of technology. Gartner, the analyst firm, even has something they call the hype cycle to kind of describe it. How, you know, one day it's 3D printing, the next day it's biotech, the next day it's drones, the next day it's this, the next day it's that, and we get really excited about it and comes up to the top of the loop and then it comes right back down to the bottom, right? And nobody's ever heard of 3D printing again. All of a sudden, you know, for the last year it's been a dearth of news, the stocks have done terrible. But one of the most interesting things about technology that I think a lot of investors don't pay attention to is that it tends to be either counter-cyclical, like gold, or acyclical entirely.
Interesting.
If you look through 2008, 2009, that time period, companies like Google, Salesforce, Microsoft, none of them saw even the slightest dip in their top line revenues. And that's because when other companies are looking to cut costs, when your mining companies and your oil companies and your electrical grids and this and that are all thinking about, oh, I can't borrow as cheaply, or I might not be able to borrow at all, I've got to cut costs. If they can replace people with software or hardware, they will. So tech businesses tend to stand up well when a market softens. And after this bull run from 2009 to today, the S&P 500 hits a new high every single day. Average bull market actually only lasts 3.7 years.
Right.
If we do see a correction, technology is a great place to be, not because it won't follow the correction, but because it'll bounce back faster.
Right.
Because those companies will probably actually have done well during the soft period of the market. So they tend to be counter-cyclical.
Okay, so are you saying that a typical investor might be able to essentially bulletproof their portfolio by having tech stocks in there when there's other market corrections?
Yeah, it's an important part of balancing the portfolio. Like any kind of counter-cyclical asset, what happens with tech is not that it stops, not that it just continues on like, say, gold, where it immediately goes inverse the market, but it actually recovers more quickly. So what you'll find with technology companies is on the far side of any big cyclical downtrend, 1987, even 2000, which was caused by an inflated technology bubble, the companies that recovered the fastest tended to be technology companies, those companies who saw their stocks rebound quickly, and that's because they've been growing revenues and growing earnings over the point of any kind of crush. Anything that affects the markets doesn't necessarily affect the technologies company ability to operate, whereas it might affect a bank who might start cutting costs, and what's that bank going to do when they cut costs? They're going to invest in technology.
Right. Now, we did have the dot-com bubble in 2000. You know, where do you think we are right now in terms of a tech cycle?
We're certainly near the top of a cycle for any market, right? If you look at the S&P 500, a significant amount of the growth in the S&P 500 has been caused by one stock, Apple. If you look at, say, the NASDAQ, 80% of the rise of the NASDAQ over the last 3 years has actually been multiple expansion. The PE ratio of the stocks in the NASDAQ 100, which are predominantly technology companies, has been expanding. So 20% of that growth is underlying earnings, and 80% of it is an increase in PE ratios, price to sale ratios, et cetera. So that multiple expansion means that eventually it's going to have to contract to some kind of norm. Either growth in the companies will have to pick up to catch up to it, or the stock market will have to correct back to kind of match traditional valuations. When that happens is anybody's guess, but technology is going to be what recovers fastest on the far side, because even if we see multiple compression, down the line, if you find a company that's growing its revenues, say 50% a year or 40% a year, you're going to see significant upside potential in that stock on the long side of that. So if you can think 7 years, 10 years out, then technology can be one of the absolutely best investments to smooth out those short-term market corrections.
Now, is that just because tech is such a high-growth industry in general, that's why it's so resilient?
It has to do with the disruption factor.
Right.
People talk oftentimes about disruptive technology, and they forget what it means. I mean, disruption is about, every business is sort of set upon some competitive pillars, right? And the same thing is true of almost every technology. If you really look at a disruptive technology, what it does is it changes the dynamics. Take Salesforce.
The disruptions are happening faster now than ever before, it seems.
Yeah, there's a lot of people who believe that it's accelerating. That technology builds on technology. You got guys like Ray Kurzweil who talk about the singularity, when everybody's going to just become cyborgs and all that.
We're going to merge with machines.
Yeah, I think Ray and John Malden and all the guys who think the singularity is coming in 20 years are optimistic because they maybe have 20 or 30 years left, so they want it in their lifetimes. It'll probably be a little longer than that.
Right.
Disruptive technology comes from sort of both sides. It tends to start at the top and kind of be a very expensive, complex technology that gets cheaper over time. And then what happens is it gets applied to the bottom of a pyramid, and then it eats up a business from the bottom. So once it hits a certain point of cheapness, it suddenly eats the business. You take Uber, and look what it's done to the taxi cab. They've suddenly taken a ton of the margin out of the business by finding excess capacity of labor over here.
Airbnb, all these different models.
Exactly.
So what trends specifically right now, some disruptive technologies you see on the horizon that investors should be watching for?
Investors have to be watching the socialization trend, the use of excess capacity, what we just talked about with Uber, with Airbnb, with Homeaway. You know, Homeaway is a great example. It's an already public company. Everybody gives Airbnb a lot of attention, but Homeaway is actually a much larger company, has more listings, it generates more revenue, it's more profitable, it operates under dozens of different brands around the world. And
so it's a sharing economy kind of trend?
Yeah, it's about excess capacity, right? What we used to think of as a sharing economy, a lot of people talked about, it's not really that's what it's about. It's about taking things that could have been commercial assets and weren't, and using the power of the internet to turn them into commercial assets. So the unemployed guy with a Toyota, he's now suddenly a taxi driver. You just took an economic asset that was sitting idle and brought it into the economy, and by doing so, when you increase the supply, you've lowered the price all of a sudden. And so that's, it's going to compress margins. In general, any business right now who relies on really high margins from a restriction of supply or a restriction of information, that business is really subject to potential disruption.
Right. So what are you telling investors right now to be watching for aside from the socialization trends?
Given where the market is today, growth, 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 growth. Oftentimes in technology, the right place to be is to be in the sort of venture side, the companies that are real early stage, a couple of years, they're going to start putting product to market and it's going to be a big thing. Right now, that's actually the worst place to be. Those multiples are incredibly high. If you look at the valuations that are going into companies like Uber on the private market, you look at the valuations on the IPOs of companies who are coming out not even profitable yet, and they're trading at, say 200 times their gross sales, which is an obscene multiple. That's not the place you want to be today. Where you want to be today is find mid-market players. Find the companies who look at what Netflix looked like in 2005, right? From Netflix from 2005 to today, didn't blink an eye during the recession, didn't care about the market crash, just doesn't matter because it provided better service for less money.
Right.
And if you can find that over and over again, so you can find that in interesting places. On the industrial side, you can find it in drones. Drones are real interesting technology. They save the Defense Department a ton of money, especially liability money and putting lives at risk, but also maintenance, et cetera. And yet they increase functionality. Drones can do things that human beings could never do.
In all these different industries, agriculture, crop monitoring,
Absolutely, yeah. So agriculture is another good example. There's a couple of companies in Silicon Valley who are tackling the agriculture problem with fully automated combine harvesters. Everybody talks about the self-driving Google car. Well, that's not going to make it on roads very soon, but there are already combine harvesters that are moving through fields 24/7, no human being on board, and can plow those fields and do all kinds of things that you couldn't do with an army of human beings. Because you know what? Robots don't get tired, they don't hurt their back, that nothing happens to them. So it's a really interesting dynamic where you have more functionality, less cost, and that's what drives a business. So you find whoever's supplying those savings elsewhere, find their business, you find growth. And if you find growth, whatever happens to the market in the short run, over a 2, 3, 4 year period of time, when you come out the other side of whatever correction it is, that company is going to look great and it's going to bounce back real quick. They didn't have the venture markets, they didn't have the education, people weren't coming out with doctorates in computer science and things like that. It was a very different sort of what we would call, an undereducated market, just to generalize it. And in those undereducated markets, an American company can come in and sort of dominate. You take a market that's now sort of fully educated, that has literacy rates on par to ours, has college graduation rates on par to ours, who's frankly sending their best people to be educated in America and sending them back home. What competitive advantage do we now have locally? They have them all. So companies like Xiaomi are going to continue to grab. And I think what you're going to find is more regionalization in the tech economy than has been there in the past. Operating systems that take off in a particular area of the world, the application software takes off in an area area of the world. A great example is Yandex. Google has been unable to break into search in Russia, and Yandex has really held that #1 spot for years. Same thing with Baidu. Google has struggled in China to win the search market because Baidu gets the local market.
Right.
And I think you're going to see more and more of that regionalization. It's going to happen on the billion-person scale, but with 6-8 billion people in the world, you're talking about a pretty large opportunity for multiple companies from multiple regions to kind of be huge, multi-billion-dollar players. I think you're going to see more and more of that.
Interesting. Well, Alex, thank you so much for joining us today. It was a pleasure.
Oh, thank you. Always a pleasure.